Okay, this lesson is 3-1, recording transactions in the general journal. So the objectives, we're going to define what a journal is and explain why it is used to record transactions, compare and contrast different types of source documents, and identify the 4 parts of a journal entry. Okay. Now, journals and journalizing. A form for recording transactions in chronological order is called a journal. Now, it's important to realize that the journal that we're going to introduce in this lesson will be used for recording transactions in the first accounting cycle. So this is the only journal we're going to use for right now. And then, this is chronological order, so it's going to be from the earliest that came in will be done first, okay? And it's a good idea to journal every day because that way you don't lose track of when stuff came in, okay? And that recording transactions in a journal is called journalizing. So here's the general journal, and like I said, this is the one that we're going to use throughout this accounting cycle. And one thing, here we got the general journal, we got a page number, the date, account title, document number, we'll get to the post reference later, and debit and credit. Now, we've talked about the T account in Chapter 2. Well, if you look right here, we're basically combining the T account. So here's the top line, and here's the vertical. So there's your T account. Same principles that we talked about. Now, a general journal, we have to do it for accuracy. Okay, so you gotta make sure everything's accurate, your writing's gotta be neat, and so forth. Everything's done in chronological order, so the earliest one that came in, that's the one that's done first, to the most recent. We do double entry accounting, so information for each transaction recorded in a journal is called an entry, and then recording of debit and credit parts of a transaction is called double entry accounting. So there's always going to be 2 parts, a debit part and a credit part. Source documents is a business paper from which information is obtained for a journal entry is called a source document. Now, if we look at our accounting concepts, we have one that's called objective evidence, and that requires that every transaction has to have a source document. Okay? And all that information you're going to need from that for the entry is on that source document. Now remember, generally an entry cannot be recorded unless there's a source document to support it. We got to have that evidence. Later on, we'll see some that we don't have that evidence, and we'll talk about how to handle that later. Okay. So for some of our source documents, you got check. It's a business form ordering a bank to pay cash from a bank account. So most of our cash transactions right now, they're going to have a check with it, be our evidence. And it says, this we give to the person we're paying. Here it tells us we'll keep this much for our source document, and we'll have the amount, the date, who it was to, and why did we write this check. Invoices, it's a form describing the goods or services sold. The quantity, the price, and the terms of sale is called invoice. Again, this is when we're going to, usually buy something on account. Okay, so here, we're going to sell something on account in this case. So here we sold it to Main Street Services. We sold a website design for $500, and we sold it on the 12th of January. Sales invoices is an invoice used as a source document for recording sale on account. That's a sales invoice. It's also referred to as a sales ticket or a sales slip. A receipt. It's a form giving written acknowledgement for cash received. So every time we receive cash, we're going to give somebody a receipt. Again, we fill this side out, give that to the customer or whoever we received cash from. This side is where we're going to get our source information. So again, it happened January 2nd. We got cash from Michael Delgado for investment. So this, the owner invested $2,000 in cash. Memorandums, it's a form for which a brief message is written to describe a transaction. So if it doesn't have a source document, this is one way we can use that. So here we bought supplies on account from Canyon Office Supplies, $220. So supplies and accounts payable, Canyon Office Supplies on January 5th. Calculator tapes, we're going to use this to, cash for sales. Basically when we, receive the cash throughout the day. So this calculator tape, we see this is for January 10th, transaction tape number 10, and it's $1,100 in cash. All right, so preparing journal entries, we book of original entry. It's a payment record. Recording used ink, not pencil. And remember, right now everything's going to be an even dollar amount, so we need to make sure we put the .00 at the end. All right, received cash from the owner as an investment. So January 2nd, received cash from the owner as an investment, $2,000, receipt number 1. So again, I want to ask myself the same 4 questions we did with the T account. What 2 accounts are affected? Well, we received cash, so cash is one of them, and owner as an investment. So that's going to be owner's equity capital account. Okay, so there's our cash account. There's our capital account. So remember, cash is an asset, capital is an owner's equity account. Okay. We received cash, so we're increasing cash. That increases his capital, so we increase the capital. Okay. We recorded increased asset on the debit side for $2,000. We recorded increase to capital on the credit side, $2,000. So now we're just taking this information and putting it into the general journal. So we write the date in the date column. Now the very first date, we got to put out the whole information. So we're going to put the year, the day, the month, and the day. Then we write the title of the debit account. Remember, now here's where it's important. Debits always go first. So here we have cash, $2,000. Step 3, on the next line, we indent a little bit, and we're going to put the credit amount. So Michael Delgado Capital, $2,000. And then we write the source document in the document number. So this receipt 1 is R1. Receipt is abbreviated with an R. Truthfully, sometimes I write this as I'm doing my debit line. All right, next we paid cash for supplies. Paid cash for supplies, $165, check number 1. So again, what 2 accounts are affected? Well, we paid cash and we received supplies. So cash and supplies. Okay. Cash is an asset, supplies is an asset. We're increasing supplies, so we're going to debit $165 in supplies. We're decreasing cash, so we're crediting $165. Okay, so again, we're going to write the date in the date column. Now, since it's the second transaction, all we have to record is the day. The only time we're going to rewrite the year and the month again is if it either changes month or changes year, or we run out of space and have to go to another page. And then again, we write the debit title, supplies, and the debit amount, $165. Then we indent, cash, credit, $165. And then with this one, the last thing we do is write the source document. Check is abbreviated C, so we put C1.